Okay, so on to collective investment schemes. So collective investment schemes are set up as trusts. They are complete with a trust deed. They also have a prospectus that outlines their investment policy and the fees that they charge. And then collective investment schemes are set up and run by management companies. These schemes are not companies themselves. They are not quoted on any stock exchange. The units are bought from and sold to management companies, not from other investors, right? The only money that collective investment schemes raise is the money that the investors pay for units. They do not raise any equity or debt capital. Collective investment schemes allow small investors to invest in professionally managed portfolio of shares or other investment instruments with a specific objective, right? The investment policy is governed by their prospectus, which should be considered, the investment policy is governed by their prospectus, which should be consistent with the category in which the scheme is registered. And then the main parties involved in a collective investment scheme includes the management company, the trustees, and the investors. The management company runs the schemes. The managers have to be registered with the registrar of collective investment schemes, and this management company sets up the scheme, it advertises the scheme, it carries out all the necessary administration and controls the investments of the funds by appointing an investment manager. And then the trustees are responsible for checking that the scheme is run according to the terms of the trust deed or the prospectus. The trust will be a company which must meet certain criteria for the trust must be a company which will meet criteria for registration as a trustee by the registrar of collective investment schemes. Investors who buy units in the schemes. So there's also investors who buy units in the scheme. And then the pricing of the units is calculated by the investment managers. The price is calculated as the market value of assets plus income and less expenses divided by the total number of units. And then details on the price calculation will also be given in the prospectus. Competition has driven fees down in the industry of collective investment schemes, so many investors no longer charge an initial fee, and they rely only on the annual management fee. Advisor fees are charged separately and may be waived if the client does not want an advisor. So the result of this change brought by competition is that many schemes have increased the minimum investment amounts for both once-off and monthly investments. So fees vary according to the type of fund. Equity funds typically charge higher fees than bond funds, which in turn charge higher fees than money market funds. All right, I think we have to ask ChatGPT why the different types of fund charge different fees, why equities are charging higher funds than bonds, and why bonds are charging higher fees than money market funds. So in addition, there may be a scaled up fee related to fund performance in excess of a benchmark. All right, so I'll note this one down as well. We'll ask ChatGPT for more context. So to avoid confusion by the fees varying according to the type of fund and according to which investment scheme, ASISA has instituted the TER, the total expense ratio, which expresses all costs or fees as a percentage of the fund's value and allows fair comparisons to be made. So now the role that is played by investment schemes in financial or investment markets. Collective investment schemes provide an avenue for many investors to enter the investment markets. A relatively small investment can secure a diversified portfolio that is reasonably managed at an affordable cost. Some private investors are also able to buy a reasonable selection, including heavyweight shares. What are those? What are heavyweight shares? But then without collective investment schemes, they wouldn't be able to participate in these markets. But without investment schemes, less wealthy investors would have to restrict their investments to a small number of stocks, right? Collective investment schemes are classified by geographical focus. We have domestic, global, and foreign. And then they also classified by investment focus. For example, are we focusing on equities, fixed interest securities, real estate, or just asset allocations, and by sector? So the investor can therefore choose to invest in specific areas of the market, including those where he or she has no knowledge or expertise, this being supplied by the management company. Right. So the collective investment schemes or the investment portfolios in these schemes are governed by Board Notice 90 under CISCA. I don't know what CISCA is. Let me search what CISCA is and then ask ChatGPT to give us some more content for this section. What is CISCA? CISCA is Collective Investment Schemes Control Act. So it's an act. All right. Now on to ChatGPT. ChatGPT. Gonna have to copy a prompt from my previous chats. Okay. I'll copy one from the chats about merchant banks. All right. In fact, let me just use the same chat. I'm going to say, hey, please explain collective investment schemes. Please explain collective investment schemes, their roles in the financial system or markets, and how they invest. What is their role as an institutional investor? Please explain in paragraph form to an actual undergrad. Add examples, scenarios, give examples of popular collective investment schemes in South Africa. And explain their role and the role they play in practice. No bullet points, no lists, just flowing paragraphs. And then I'll add that please also explain this part. I want that part about the fees. Okay, almost done. Pricing. All right, so collective investment schemes are essentially pooled investment vehicles that allow many individuals and institutional investors to combine their money into a single fund, which is then professionally managed according to a clear investment mandate. So, for an actuarial graduate or an actuarial undergrad, it helps to see collective investment schemes funds as intermediaries that translate household savings into large, diversified portfolios spanning equities, bonds, property, or money market instruments. They are set up as trusts, not companies, which means the assets legally belong to the investors while the management company runs the scheme on behalf of those investors. So each scheme is governed by a trust. Each scheme is governed by a trust deed and a prospectus, both of which outline the investment strategy, the fees, the limits, and the risks. Right? Units in the fund are bought directly from the management company rather than traded between the investors. So the scheme only receives money when new units are purchased and only pays money when the units are redeemed. This structure allows even small investors to gain access to well diversified portfolios that would otherwise be too expensive or complex for them to construct alone. So, in practice, a collective investment scheme relies on three key in practice, a collective investment scheme relies on three key parties working together. The management company, often called the MenCo, is responsible for creating the fund, marketing the fund, performing all administration, and appointing an investment manager to decide what assets the fund buys or sells. The trustees act as independent overseers who ensure that the fund operates strictly within the terms of the trust deed and relevant regulations. Investors, on the other hand, they simply buy the units, and the value of these units fluctuates with the underlying asset performance. Unit prices are calculated using a straightforward formula: the total market value of all the assets plus any income earned minus any expenses divided by the total number of units in issue. So this process ensures transparency and consistency so that investors always receive a fair value when buying or selling their units. So the way collective investment schemes invest depends entirely on the mandate described in the prospectus. An equity fund, for example, invests mainly in shares listed on exchanges like the JSE. A bond fund invests in government bonds, corporate bonds, or money market instruments. A property fund invests in listed real estate companies or direct properties assets. A money market fund holds very short term, low risk instruments such as treasury bills and negotiable certificates of deposits. So consider a South African investor putting 500 rands per month into a balanced fund offered by Allen Gray or Coronation. That small contribution is pooled with billions of rands from other investors, and the fund manager allocates it across shares, bonds, and cash to achieve long term growth while controlling risk. Without this pooling mechanism, that investor would struggle to build similar diversification or to access professional asset managers. As institutional investors, collective investment schemes fund collective investment scheme as institutional investors, collective investment schemes funds play a massive role in the financial markets because they aggregate the savings of millions of people and deploy them across asset classes. In the equity market, they become major shareholders that influence corporate governance and market liquidity. In the equity market, they become major shareholders that influence corporate governance and market liquidity. In the bond market, they purchase government and corporate bonds, helping to finance public infrastructure and private sector expansion. In the money market, they supply short-term funding to banks and corporations or and companies, right? A South African example is the 91 money market fund. 91 money market fund. Let me quickly search 91 money market fund. Okay. 91 money market fund. Okay, a couple of news articles that come up and then the company's website. All right, I'll have a look at this. So a South African example is the 91 money market fund, which serves as a major lender in the short-term debt market by buying bank issued papers and treasury bills. Another example is Allen Gray's equity fund, which is a large institutional investor in top JSE companies and can significantly influence market pricing simply through its asset allocation decision. One useful aspect for actuarial thinking is understanding the fee structure, right? Equity funds generally charge higher fees than bond funds because managing equity portfolios requires more research, active trading, and deeper analysis. That is why equity funds charge higher fees in general, right? Equity managers often employ analysts to study industries, model companies, and evaluate management teams, which increase their operational cost or their operating cost. Bond funds charge less because fixed income investing tends to be more stable and less research intensive. While money market funds charge even lower fees because they invest in very short term instruments with minimal credit and duration risk. Many collective investment schemes also include performance fees, which means the manager earns an additional percentage when returns exceed a specific benchmark, such as outperforming the JSE All Share Index, right? That is a performance fee that is charged when their returns exceed a benchmark. So these fees scale up only when the manager delivers superior performance I think this sort of incentivizes the investment managers to select assets that, or to put more effort into managing the fund so that it performs better. Because if it performs better, then they'll earn more money in the form of performance fees, right? So these fees scale up only when the manager delivers superior performance, aligning incentives, but also increasing investor costs during good periods. To simplify fee comparisons across funds, Asisa introduced the total expense ratio. Asisa, is it an as? Let me search. I forgot what it stands for, but I know Asisa. Asisa is the Association for Savings and Investment in South Africa. Okay. So Asisa introduced the total expense ratio, TER, which expresses all the costs, the management fees, the administration fees, and other expenses as a percentage of the fund's value, right? In the broader financial system, collective investment schemes create a bridge between private savings and large-scale investment markets. In the broader financial system, collective investment schemes create a bridge between private savings and large-scale investment markets. Okay. They allow investors to target specific sectors or geographies without needing expertise in those areas. Someone with no knowledge of fixed income markets can place money into an income fund and rely on professional portfolio managers to assess the risk, duration risk, to assess the credit risk, duration risk, and yield opportunities. Similarly, an investor interested in global technology stocks can invest in a global equity fund run by firms like Coronation, 91, Cetrix, or Old Mutual. So each of these companies operates multiple collective investment scheme funds registered under CISCA. We said CISCA is the Collective Investment Schemes. It's an act. I forgot. It is an act. Okay, CISCA. CISCA is a Collective Investment Schemes Control Act. So each of these companies operates multiple collective investment schemes registered under the Collective Investment Schemes Control Act and regulated through Board 90, which sets the rules for diversification, asset limits, and risk control. In practice, collective investment schemes funds are crucial for market stability, liquidity, and capital allocation, forming one of the most important institutional investor groups in South Africa's financial ecosystem. So that is collective investment schemes. And then now moving on to investment management companies. Investment management companies. All right, so investment management companies, these are often referred to as fund managers or asset managers. So investment management companies perform a range of activities centered around the core service of investing client assets, right? Their front office functions, including buying and selling investments, formulating stock selection and asset allocation decisions, research, cash management, and then they have middle office. Middle office functions include compliance, performance, and risk measurement, and then they have back office functions including accounting, transaction, and income processing and settlement, scrip lending. So firms are increasingly unbundling some of these services and outsourcing an increasing number of functions. in order to focus on the core service of investment. And then the role played by investment management companies in the markets. So remember, from collective investment schemes, we said that the management company will appoint an investment manager to invest the funds of the scheme. So as noted, investment management companies are primarily involved in stock selection and asset allocation decisions and buying and selling investments. In many countries, investment management companies handle immense volumes of assets. The industry is typically also very concentrated, with a small number of firms dominating the industry or dominating the market. So short-term fund performance is often a key factor in attracting and retaining clients. Short-term fund performance is often a key factor in attracting and retaining clients. As a result, concern has been expressed that fund managers have become too influential in determining asset allocation and the direction of capital, and the real value of active investment versus passive index tracking funds is currently getting some media attention. Issues that were cited include herd-like behavior, excessive focus of short-term results, closet passive investments while charging active management fees, insufficient attention to corporate governance issues, insufficient allocation to new asset classes such as private equity, venture capital. All right, so now on to ChatGPT. Please provide more context. I'll just use the same prompt as I did for collective investment schemes. Okay, let me type. Please explain investment management companies. Please explain investment management companies, their roles in the financial system or markets, and how they invest. What is their role as an institutional investor? Add examples, scenarios, explain in paragraph format to an actual undergrad. Give examples of popular investment management companies in South Africa. Investment management companies in South Africa and the role they play in practice. Right. Okay. All right. So investment management companies, often called asset managers or fund managers, occupy one of the most influential positions in the financial system because they are responsible. Okay, let me start afresh. Investment management companies, often called asset managers or fund managers, occupy one of the most influential positions in the financial system because they are responsible for investing money on behalf of individuals, pension funds, insurers, corporates, and other institutions. For an actual undergrad, the simplest way to understand investment management companies is to think of them as professional stewards of capital whose job is to allocate assets in a way that meets their clients' objectives. So their main job or their main role is to allocate assets in a way that meets their clients' objectives, whether that is long-term growth, income generation, inflation protection, or capital preservation. Those are some of their objectives. They do not hold the assets themselves. They manage them in terms of mandates and investment agreements, right? Their work is built around three operational layers. The front office is where the investment decisions are made. The analysts and portfolio managers choose which shares, which bonds, or other assets to buy or sell. Excuse me. They decide how much cash to hold and create the overall asset allocation strategy. That is the front office. The middle office ensures portfolios remain compliant with mandates and regulatory limits. They measure performance. They monitor risk metrics such as tracking error or value at risk. The back office handles the operational engine, trade settlement, accounting, income collection, reporting, and administration. Increasingly, firms outsource non-core functions to focus on the investment process itself, right? So firms now outsource most of these functions, which are not core, to focus on the investment process itself. In the financial markets, investment managers act as major institutional investors in the financial markets. So I think now we're on the role they play in the financial markets. In the financial markets, investment managers act as major institutional investors because they deploy vast amounts of capital across asset classes, right? They are often among the biggest shareholders in listed companies and significant buyers of government and corporate bonds. For example, a large South African asset manager like Coronation or 91 may hold billions of rands in equities such as Naspers, Anglo American, or Standard Bank, alongside bond holdings in government debt like the R2030 or R186. I don't know what those are. I think they are just government bonds or government debt. Let me quickly search R2030 and R186. The choice between R2030 and R186 depends on your investment goals, as they are different South African government bonds, but the R186 recently undergone significant changes, being split and phased out, making the R2030 8% maturity 2030 a more prominent liquid benchmark for the market now, especially in late 2025. All right, so these are government bonds. Let me not go into the details. So the R2030 or R186 are those are some government bonds. So we said large South African asset managers like Coronation or 91 may hold billions of rands in equities such as Naspers, Anglo American, or Standard Bank, alongside bond holdings in government debt like the R2030 or R186. So when these firms adjust their portfolios, the market often moves with them because of the scale of their positions, right? Their role is particularly visible when pension funds or life insurers outsource their assets to investment managers. Their role is visible when pension funds or life insurers outsource their assets to investment managers. Okay. In such cases, the asset manager becomes the key decision maker in determining how retirement savings, insurance reserves, or endowment funds are allocated between equities, bonds, property, money market instruments, or and alternative assets. So, investment managers or the asset managers, they are the key decision makers in determining how retirement savings, the reserves of insurance companies or endowment funds are allocated between equities, bonds, property, money market instruments, and alternative assets. So that is asset allocation. This makes them critical to how capital flows through the economy. Their investment approach follows structured processes that combine research, valuation, macroeconomic analysis, and risk modeling. A portfolio manager might, for instance, determine that global inflation will trend lower over the next year. A portfolio manager might, for instance, determine that global inflation will trend lower over the next year and therefore increase the fund's exposure to long duration bonds. I think we need some more context on this one. So I'll open a separate window and ask ChatGPT, all right, to explain a bit more. So I'll say, let me start from here. All right, so from here to there, that part about longer duration bonds. Let me open a new chat and ask, from this paragraph, please explain more on this sentence. Right. What's the logic behind? I need more explanation on the sentence where that says a portfolio manager might, for instance, determine that global inflation will trend lower over the next year and therefore increase the fund's exposure to long duration bond. What's the logic behind this? All right. So here's the logic in clear, intuitive way, especially from an actuarial or financial markets perspective. When a portfolio manager expects global inflation to trend lower, they are implicitly expecting interest rates to fall in the future. So in most countries, including South Africa, central banks respond to lower inflation by cutting policy rates or at least stop further increases, right? Bond prices and interest rates move in opposite directions. So when interest rates fall, bond prices increase. Now, long duration bonds, for example, long dated South African government bonds like the R2037 and R2048, or long US treasuries, have much higher interest rate sensitivity than short duration bonds. This sensitivity is captured by duration and convexity. All right. Because of this, long duration bonds gain more in price when interest rates fall. A small drop in yields might increase a long bond's price by, say, a small drop in interest rates might increase the price of a long duration bond by 12 to 20%, but a short duration bond its price might only move by 1 to 3%. So the logic is, the lower expected inflation, the lower the future interest rates, because central banks cut rates or stop hiking the rates. So lower interest rates mean bond prices go up. This is the standard invest bond price yield relationship. Long duration bonds rise more when yields fall because their cash flows are far away in the future. Their present value is very sensitive to discount rate changes. Therefore, if you expect inflation to fall, long dated bonds become attractive. You buy them now to benefit from the capital gains when yields decline. And then here's a simple scenario to make it concrete. Imagine the sub repo rate is currently high because inflation has been sticky. A portfolio manager at Coronation thinks global inflation, especially the US or EU inflation, will fall sharply as um, as supply chain pressures ease and commodity prices stabilize. They believe the US Fed and the ECB will cut rates within the next 12 months. South Africa often follows these global cycles, especially because foreign bond investors react to global yield movements. In South Africa, 10-year yields are currently at, say, 11%, and the manager expects them to fall to 9.5%. That's 150 basis points drop. That 150 basis points drop represents a bigger price jump for long dated South African government bonds. Buying long duration bonds now lets the portfolio lock in these gains before the market moves. Okay. This is why inflation views, especially global inflation, are directly linked to duration positioning in fixed income portfolios. It does make sense. Okay, where was I? Back to my notes. Uh, okay, I lost my position. Where was I reading? Let me search duration. All right. All right. So we were saying a portfolio manager might, for instance, determine that global inflation will trend lower over the next year and therefore increase the fund's exposure to long duration bonds. Or an analyst may conclude that a local retailer is undervalued relative to its fundamentals and propose adding it to the equity portion of the balanced fund. Investment management companies also decide how to split allocations between different asset classes, known as the asset allocation decision, which often has a larger long-term impact on returns than individual stock selection. Which often has a larger long-term impact on returns than individual stock selection. So the asset allocation decision as a whole has a larger long-term impact than individual stock selection. Okay. Okay. So actuaries working within this environment would engage in performance attribution, risk modeling, scenario analysis, and asset liability modeling for clients such as pension funds or insurers, right? Because these companies handle enormous pools of assets, their behavior can influence market dynamics. One example is head-like behavior. When managers follow similar views on because these companies handle enormous pools of assets, their behavior can influence market dynamics. One example is herd-like behavior. When managers follow similar views or mimic one another to avoid underperforming their peers, which can create momentum-driven markets, right? One example is herd-like behavior, where managers follow similar views or mimic one another to avoid underperforming peers, which can create momentum-driven markets. Okay. Another challenge is the focus on short-term performance. Since clients often compare quarterly returns and shift assets to whichever manager is performing best at the moment. This can pressure managers to prioritize tactical wins over long-term strategy. There is also debate around closet indexing, where a fund charges high active management fees but actually invests in a portfolio that looks very similar to the benchmark index. At the same time, asset managers are increasingly being pushed to take corporate governance seriously, using their voting power to influence how companies behave on issues like board composition, executive pay, and sustainability. Despite these pressures, they remain central in directing capital and shaping investment trends. In South Africa, well-known investment management companies include Allan Gray, Coronation, 91, Old Mutual, Sanlam, and so on. So each manages a wide range of funds from pure equity funds and bond funds to balanced funds, money market funds and global portfolios. Money market funds and global portfolio. Each one manages a wide range of funds from pure equity funds and bond funds to balanced funds, money market funds, and global portfolios. So, for instance, Allan Gray is known for its value investing style, often taking contrarian positions in the market. Value investing style. Okay. Coronation is one of the largest managers of institutional assets and has a significant influence on the JSE through its active positions. 91 manages both local and global strategies and is a major investor in emerging market debt. These firms collectively manage hundreds of billions of rands and play a crucial role in financing listed companies, supporting government borrowing, and facilitating capital formation. When they invest in infrastructure bonds, for example, they help fund roads, renewable energy projects, or water systems. When they allocate to equity, they help companies raise capital and grow. So ultimately, investment management companies shape how savings become productive investments in the economy. They translate individual contributions, pension fund inflows, and corporate reserves into diversified portfolios that support economic growth, market liquidity, and price discovery. So for actuarial students, this industry offers deep exposure to risk management, performance evaluation, governance, and long-term financial modeling, all of which lie in the heart of modern investment practices. So that is investment management companies. And then on to self-administered retirement funds. Self-administered retirement funds. So self-administered retirement funds, the role they play in the investment markets. So many employers set up retirement funds as part of the benefits provided to their employees. The aim of the retirement fund is to provide pensions for the workforce when they retire. A self-administered retirement fund is one that is responsible for its own investment strategy A self-administered retirement fund is a retirement fund that is responsible for its own investment strategy, right? So almost all retirement funds or almost all retirement plans are funded. The employer and usually the employee make contributions over the working lives of the members. There are two basic types of retirement funds: a defined benefit and a defined contribution. In a defined benefit, the member's pension is determined by a specific formula. Members contribute to the fund at a set rate, and the employer makes up the difference required to finance the benefits. In a defined contribution, there is a set rate of employer and member contributions paid into the members' individual funds. The pension payable is determined by the size of the fund and the annuity rates at the date of retirement. So in the past 20 years, defined contribution funds have become more common, and many existing defined benefit funds have switched to defined contribution arrangements. This has been influenced by investment performance, as members want defined contribution when markets are doing well, but during long periods of underperformance, they call for defined benefits. The reason is clear. Members see employers taking a contribution holiday in defined benefits. Members see employers taking a contribution holiday in defined benefit funds in good market conditions, and they see employers not having any responsibility for defined contribution funds when market conditions are bad. The main parties involved in retirement funds include the employer, the employee, the trustees, and the fund managers. The employer sets up the retirement fund while the employer sets up the retirement fund, will make contributions to the fund at a set rate. They will make contributions to the fund at a set rate for defined contribution, or at a rate determined periodically by an actuary for a defined benefit fund. Employees will usually make contributions as well, and they eventually receive the benefits. Trustees are responsible for checking that the fund is run according to the terms of its rules. Their primary responsibility is to ensure that members' pensions are safeguarded. And then the fund managers, they are appointed by the trustees. They are needed to invest the self-administered retirement funds assets. So a typical South African retirement fund invests mostly mostly in South African equities as well as longer dated fixed interest stocks. There may be some investments in overseas securities, but there are regulatory restrictions on the percentage of total assets that may be invested offshore. A small proportion of the assets might be invested in property, money market investments, and index-linked gilts. The investment limits are set out in Regulation 28 of the Pension Funds Act. And then the role that they play in investment markets. Retirement funds are significant investors that oversee substantial volumes of wealth. They are long-term investors. In extreme cases, a member aged 20 today could still be drawing a pension in 80 years' time. There is a need to continue to provide a living income at that future date, and therefore the invested assets need to provide a real return. That is, a return that is over and above inflation. In the fixed interest markets, retirement funds tend to buy longer dated bonds, and to In the fixed interest markets, retirement funds tend to buy longer dated and to an extent medium dated stocks to meet their liability to pensions already in payment. Okay. For the medium dated stocks, it's just to meet their liability for the pensions that are already in payment. All right, so let us break it here.